Welcome, everyone, to another explainer. Now, have you ever caught yourself wondering what's actually happening under the hood of the stock market? Well, today we are completely demystifying the inner workings of stock market pricing. Our core mission for this explainer is to really understand the call auction system. It's this incredible hidden architectural framework that basically keeps modern financial exchanges running smoothly when, let's be real, you'd totally expect absolute chaos.
Okay, let's dive into this. Here is our roadmap so you know exactly how we're going to break this all down. First, we'll look at the continuous trading problem, which naturally leads us right into the call auction solution. Then, we'll ground this in reality by exploring India's 4 auction regimes. After that, we're going to get a little quantitative and demystify the math behind finding the perfect price. And finally, we'll wrap up by looking at how this has become a global market standard. But before we get into the weeds, I want to start by posing a bit of a provocative question to you. Seriously, think about this. How does a stock find its exact opening price before the market even officially opens? Most of us just assume that stock markets are these continuous, real-time streams of matching, right? The bell rings and boom, buyers and sellers are instantly trading. But if huge global news breaks overnight, how on earth does that very first trade of the morning not just trigger absolute panic and massive price swings? Section 1, the continuous trading problem. So to really appreciate the solution, we first have to establish a baseline of how everyday trading normally works. Throughout a typical trading day, the market runs on what's called a continuous double auction, or a CDA. Picture standard trading like a busy, high-speed highway. You've got cars representing buy and sell orders, and they are merging at will, instantaneously, based solely on when they arrive and what price they want. Now, this is incredibly efficient when traffic is moving smoothly, but what happens when that traffic suddenly spikes? Well, if you have low liquidity, meaning not enough cars on our metaphorical highway to absorb a disruption, and suddenly you get slammed with massive institutional order inflows, you've got a recipe for a disaster. Massive orders merging into a thin market cause absolute pile-ups. We call these crashes, in financial terms, extreme price slippage and wild volatility. And this precise problem of transient order flow imbalances is exactly what exchanges had to solve to protect the entire market. Section 2. The call auction solution. Enter the architectural paradigm designed specifically to fix this volatility. And this brilliantly illustrates the difference between the two concepts. If continuous trading is that chaotic, high-speed highway with instant matching and asymmetric flow, the call auction system acts a lot more like a ferry terminal. Instead of letting cars just blindly speed onto a highway one by one, the ferry terminal batches all the vehicles, the orders, over a specific window of time. It holds them securely in an aggregate collection area, processes the total demand, and then they all depart safely together, executing simultaneously at one single mathematically optimized price. And the economic objectives here are just beautiful in their efficiency. By batching orders like this, the exchange basically transforms an asymmetric, totally messy flow of individual bids into super clean, consolidated market demand and supply schedules. This fundamentally allows the system to consolidate fragmented liquidity, vastly improve true price discovery, narrow down bid-ask spreads, and virtually eliminate those nasty market impact costs that come from sudden imbalances. Section 3. India's 4 auction regimes. Okay, so how is this theory actively applied in the real world? Let's look at the brilliant framework mandated by SEBI in Indian capital markets. If we just chronologically walk through a trading day, we can see exactly when these batching ferry terminals jump into action to keep prices stable. It all kicks off at 9 a.m. with the pre-open session, moves into hourly slots starting at 9:30 a.m. for specific stocks, and then finishes up the day at 3:15 p.m. with the closing auction session. Now, what's really interesting about this slide is how the pre-open session operates for liquid cash equities and futures. Check this out. From 9 a.m. to 9:15 a.m., the market isn't even open for continuous trading. It's just sitting there collecting orders, absorbing all the overnight global developments and corporate news. And here's the genius part. To prevent massive institutional players from gaming the system by placing and then pulling fake orders at the absolute last second, the order entry window has a system-driven, completely random closure somewhere in the 7th or 8th minute. No one knows exactly when it'll shut. Then we have the periodic call auction, or PCA. This is a mechanism designed specifically for illiquid stocks, meaning securities that see less than 50 trades a day. Rather than letting them trade on the continuous highway where a single rogue order could radically spike the price, they are entirely segregated into 6 hourly auction sessions throughout the day.
Plus, they are capped by a static maximum 20% daily price band. This is specifically put in place to curb microstructural illiquidity and stop price manipulation in its tracks.
To round out the Indian framework, we have the closing auction session that runs between 3:15 p.m. and 3:35 p.m. This is absolutely crucial because it locks in an accurate daily settlement price, essentially minimizing the ability of institutions to push prices around at the end of the day to benefit their derivative positions. And lastly, we have special call auctions. These are event-driven sessions for things like initial public offerings or when a market is resuming after a massive circuit breaker halt. In these special cases, they run entirely without standard price bands, allowing the market to establish a completely uninhibited baseline valuation. Section 4. Finding the perfect price.
All right, it is time to go under the hood. Let's demystify the actual quantitative mechanics of how this single clearing price is calculated. When the collection window finally closes, the exchange's matching engine calculates cumulative demand and cumulative supply. Let's gently translate the math you're seeing into plain English. At any given price level, the executable volume is quite simply the minimum of either cumulative demand or cumulative supply. It's logical, right? You can only trade as many shares as there are matches for. So the crucial point is incredibly straightforward. The matching engine scans across all possible price points, and its ultimate goal is simply to find the exact price that maximizes the absolute number of shares changing hands. The core algorithm is represented by this maximum executable volume formula, and it basically just dictates that the price facilitating the highest total trade volume wins. But of course, you might be wondering, what if two different price levels result in the exact same volume of shares being traded? Well, the algorithm relies on a highly systematic quantitative hierarchy. First, it looks for the maximum executable volume. If there happens to be a tie there, it steps down to the minimum surplus role, looking for the price that leaves the smallest imbalance of unmatched orders. And if by some crazy chance it's still tied, it systematically steps down again to a midpoint resolution fallback, designating a prior reference price as the final equilibrium. Let's move to and see how this builds using some real order book data. Imagine we're looking at two potential clearing prices. Down at 103 rupees, our cumulative demand and supply give us an executable volume of 11,500 shares. But step up to 104 rupees, and suddenly the order book allows for an executable volume of 21,300 shares. The math proves it outright. 104 rupees is chosen as the perfect opening price purely because it facilitates a much higher trade volume. It executes almost double the shares, making a whole lot more market participants happy. Section 5. A global market standard. Now, I want to zoom out for a second because this specific market plumbing isn't just an isolated Indian phenomenon. This system is literally the universal bedrock of global finance. Just take a look. From the National Stock Exchange in India all the way to the NASDAQ and the New York Stock Exchange in the US, which rely heavily on their opening and closing crosses, the London Stock Exchange runs their uncrossing sessions at 8 a.m. and 4:30 p.m. The Toronto Stock Exchange does the exact same thing. Virtually all major execution venues globally rely entirely on call auctions to manage their absolute most volatile, high-stakes open and close periods. So I want to leave you with this final, slightly provocative thought. The next time you wake up to just incredibly chaotic global news overnight, and you watch the market open smoothly at a single stable price without instantly crashing, ask yourself, what complex, invisible mathematical net just quietly protected the integrity of the market? Because it's the call auction system, always working behind the scenes. It's fascinating stuff. Thank you so much for joining me on this explainer, and keep looking out for those hidden mechanics operating in the real world.